I bet you didn't know how exciting the stock market can be. Welcome to the big show, the Stock Market Explained. All right, folks, listen up. This is Kramer, and I'm here for you. We're talking about the stock market, the place where fortunes are made. Sounds complicated? Nonsense. I'm gonna break it down, make it simple, make it clear, so you can get in the game and win. Booyah! Are you ready? Let's go. The stock market, people. It's not some exclusive club for Wall Street suits. No, sir, it's for everyone. It's a giant marketplace. Think of a farmer's market, but instead of apples and oranges, we trade pieces of companies. These pieces are called stocks. You buy a stock, you own a tiny part of that company. It's that simple. Really, you become a part owner. Imagine that. Why is this so essential? Why should you care? Because this is where your money can grow. Not just sit in a sleepy bank account. No, we want action. We want growth. The stock market offers that potential. It connects companies needing money to grow with people like you who have money to invest. It's a win-win, a beautiful thing. It fuels innovation and builds wealth. So many people are scared of it. They think it's gambling. They think it's too risky. And yes, there are risks. I won't lie to you. But with knowledge, with a plan, you can manage those risks. This isn't about throwing darts at a board. It's about smart choices, informed decisions. And I'm here to give you the basics, the foundation you need to start strong. So pay attention. This is important stuff. Why invest? Why jump into this stock market arena? Because your money should be working as hard as you do. That's right, hard-earned cash needs to pull its weight. Inflation, that sneaky thief, eats away at your savings. Money under the mattress, it's losing power every single day. Investing is your shield, your weapon against inflation. It's about building for the future, your dreams. Don't just save, invest. Think about it, people. Do you want to work forever? No. You want financial freedom. You want choices. Investing is a key path to get there. It's about compounding. That's the magic word. Your money makes money, and that money makes more money. It's like a snowball rolling downhill, getting bigger and bigger. That's the power we're talking about. Booyah! Owning stocks means you own a piece of a business. When that business does well, you do well. Think of your favorite companies, the ones whose products you love. You can be a part of their success story, not just a consumer, but an owner. Their profits can become your profits. Their growth can fuel your portfolio's growth. It's about participating in the economy's success, not just watching from the sidelines. So, investing isn't just for the rich, it's for anyone who wants a better financial future. It's for your retirement, for your kids' education, for that dream vacation, for peace of mind. It takes discipline, it takes patience, but the rewards can be huge. Don't let fear hold you back. Let knowledge propel you forward. Let's make that money work. Alright, let's get a little technical. But stay with me. This is important stuff. The primary market. This is where stocks are born. Brand new. When a company decides to go public, it's called an IPO. Initial public offering. Remember that. The company sells its shares directly to investors for the first time. To raise capital, money to grow, to expand, to innovate. Think of it as the factory fresh off the assembly line shares. This is where the big institutions often get first dibs. Then, there's the secondary market. This is where most of us play. This is your arena. Think of it like a used car market, but for stocks. After the IPO, stocks trade here, between investors like you and me. The company itself isn't directly involved in these transactions. One investor sells, another buys. The New York Stock Exchange, NYSE, NASDAQ, those are secondary markets. Big time. So, why the distinction? It matters. In the primary market, the money goes to the company, helping it fund its big ideas and projects. This is crucial for economic growth, folks. It's how new industries are born and old ones reinvent themselves. It's the lifeblood of capitalism. But it can be harder for individual investors to get in on IPOs at the ground floor. Often you need connections or a big account. The secondary market is where the action is for most of us. It provides liquidity. That means you can buy and sell stocks easily. If you want to sell your shares, there's usually a buyer. If you want to buy, there's usually a seller. Prices fluctuate based on supply and demand, and news, and sentiment, and a million other things. This is where you can find opportunities. To buy low and sell high, that's the dream. This is where fortunes can be made and lost if you're not careful. You want to play the game? You gotta speak the language. First up, stock. We've touched on this, but let's nail it down. A stock is a share, a piece of ownership in a publicly traded company, sometimes called equities. Fancy word, same meaning. You buy Apple stock, You own a tiny slice of Apple, you buy Ford stock, you own a bit of Ford. It gives you a claim on the company's assets and earnings, and sometimes voting rights, power to the people. Next, your command center, the brokerage account. This is where the magic happens. You can't just walk onto the stock exchange floor and start yelling, "Buy!" No, you need a broker. A brokerage account is an account you open with a licensed brokerage firm. Think of them as your gateway to the markets. They execute your buy and sell orders. Online brokers have made this super easy, accessible to everyone with an internet connection. Then there's the DMAT account. Dematerialized account. Sounds fancy, but it's simple. Back in the old days, you got paper stock certificates. Can you imagine? Piles of paper. What a mess. A DMAT account holds your shares electronically, like a bank account but for your stocks and bonds. Safe, secure, and super convenient. When you buy shares, they get credited to your DMAT. When you sell, they get debited. Easy peasy. So, stock equals ownership. Brokerage account is your trading portal. DMAT account is your digital vault for shares. These are the absolute basics, folks. You need to understand these terms cold. Before you even think about placing your first trade, knowledge is your armor in this game. Don't go into battle without it. We're building your foundation brick by brick. Section 5. Talking the talk essential lingo. You need to know more lingo, you're becoming a pro. Let's talk prices, the bid and ask price. When you look up a stock, you'll see two prices. The bid is the highest price a buyer is willing to pay for a stock. The ask, or offer, is the lowest price a seller is willing to accept. The difference between these two? That's the spread. Think of it as the dealer's cut, in a way. Understanding this helps you understand market liquidity and how your orders get filled. Crucial stuff. Now for a lifesaver, the stop-loss order. This is your safety net, your parachute. Investing has risks, remember? Prices can go down. A stop-loss order is an instruction to your broker to sell a stock if it drops to a certain price. Your stop price. It helps limit your potential losses on a trade. It's like saying, if things go south, get me out at this point. A smart tool for managing risk. Don't trade without it. Why is a stop loss so important, especially for beginners? Because emotions can wreck your portfolio. Fear and greed. When a stock starts falling, panic can set in. You might hold on too long, hoping it'll bounce back. And watch your losses mount. Ouch! A stop loss takes the emotion out of it. It's a preset decision, made when you're calm and rational. It protects your capital, your precious capital, which you need to stay in the game. So bid and ask tell you the current market. Stop loss protects your downside. These aren't just fancy terms, people. They are tools. Powerful tools in your trading arsenal. Learn them, understand them, use them wisely. Don't just jump in blind, that's how you lose your shirt. And Kramer doesn't want you losing your shirt, he wants you to win. Section 6. Getting in the game. Your step-by-step guide to making your first trade. Ready to make a move? Ready to become an investor? Here's how you get started. Step by step. First, open your accounts. You need that brokerage account, and usually, a DMAT account linked to it. Research different brokers. Look at their fees, their platforms, their research tools, their customer service. Many online brokers offer low-cost trading. It's easier than ever to get set up. Fill out the forms, submit your documents, and you're almost there. Step 2, fund your account. You can't buy stocks with good intentions. You need cash. Decide how much you're comfortable investing, and I mean comfortable. Money you can afford to risk. Especially when you're starting out, don't bet the farm. Transfer funds from your bank account to your brokerage account. Most brokers make this process simple and electronic. See that balance in your account? That's your ammo, your capital to deploy into the market. Exciting, right? Step 3, learn the basics, and then learn some more. Before you click that buy button, educate yourself. Understand what drives stock prices. Learn about different types of orders, market order, limit order. Understand the risks involved. Seriously, read books, watch videos, follow market news. This guide is a starting point, but your learning never stops. The more you know, the better your decisions will be. Knowledge is power and profit. Step 4, research, research, research. Don't just buy a stock because your barber told you to. No, do your own homework. Due diligence, folks. Look at the company. What does it do? Is it profitable? Does it have debt? What are its growth prospects? Who are its competitors? Read its financial reports. Understand its business model. There are tons of resources online for research. Make informed choices. Don't gamble. Invest. Then and only then are you ready to place that first trade. Booyah! Section 7. Choose your weapon. Different ways to play the market trading styles. Not all trading is the same, people. You need to find a style that fits you, your personality, your time commitment, your risk tolerance. First up, intraday trading or day trading. This is fast-paced, high energy. You buy and sell stocks within the same day. No overnight positions, in and out. Day traders try to profit from small price movements. It requires focus, discipline, and quick decisions, not for the faint of heart, and not for beginners usually. Next we have swing trading. This is a medium-term approach, my kind of speed for many. Swing traders hold stocks for a few days to a few weeks. Trying to capture a swing or a short-term price movement, they use technical analysis, looking at charts and patterns, and sometimes fundamental analysis too. It requires less constant monitoring than day trading, but you still need to keep an eye on your positions. It's about catching the wave, riding it, and getting out. Then there's position trading, or long-term investing. This is the marathon, not the sprint. Position traders hold stocks for months, years, even decades. They focus on the company's long-term fundamentals, its growth potential, its competitive advantages. Think Warren Buffett, buy and hold. Short-term market noise, they ignore it. They believe in the company's long-term story. This requires patience, lots of it, and a strong stomach to ride out the market's ups and downs. So, which one is for you? Intraday for the adrenaline junkies with time on their hands. Swing trading for those looking for medium-term gains. Position trading for the patient, long-term believers. There's no right or wrong answer. It's about what suits your goals and your life. You might even try a mix. But understand the differences before you dive in. Choose your weapon wisely, soldier. Section 8. Knowledge is power. Where to go to get smarter about stocks. You think this guide is all you need? Wrong. This is just the appetizer. The main course is continuous learning. The market is always changing, always evolving. You need to stay informed, stay educated. So, where can you go to get smarter? First, reputable financial news websites. CNBC, where you find me, Bloomberg, Wall Street Journal, Reuters. They provide news, analysis, and market data. Read them daily. Stay on top of what's happening. Know what's moving the markets. Books. Yes, good old-fashioned books. There are classics on investing that are timeless. Books by Benjamin Graham, The Intelligent Investor, The Bible. Books by Peter Lynch, One Up on Wall Street. These guys are legends. Learn from the masters. They teach you about value investing, growth investing, market psychology. Go to your library. Go to a bookstore. Absorb their wisdom. It's priceless. Knowledge from books builds a solid foundation. Online courses and educational platforms. The internet is a goldmine of information, if you know where to look. Websites like Investopedia offer dictionaries, articles, tutorials. Many brokers provide educational resources for their clients. There are online courses on Coursera, Udemy, Khan Academy, covering everything from basic concepts to advanced strategies. Some are free, some are paid. Find ones that are credible and suit your learning style. Be a sponge, soak it all up, and don't forget company investor relations pages. If you're interested in a specific company, go to their website. The investor relations section is packed with info. Annual reports, quarterly earnings calls, presentations. This is direct from the horse's mouth. Learn about the company's strategy, performance, and outlook. This is key for your research. The more you know, the less you fear, and the more confident you'll be in your decisions. Get learning. Section 9, Final Bell, Cramer's quick tips for rookies and the never-ending homework. Alright, the final bell is ringing on this 101 guide, but your journey is just beginning. Here are some quick tips from your pal Kramer. Number 1. Start small. Don't dive in with your life savings. Dip your toes first. Learn the ropes with a small amount. Gain experience. Build confidence. It's okay to make mistakes, as long as they are small ones you learn from. Rome wasn't built in a day, and neither is a strong portfolio. Number 2. Diversify. Don't put all your eggs in one basket. Seriously, this is investing 101, but so many forget. Spread your investments across different stocks, different sectors, maybe even different asset classes later on. This helps reduce your risk. If one stock or sector tanks, your whole portfolio doesn't sink. Diversification is your friend, your best friend in this market. Remember that, always. Number 3, control your emotions. This is huge. Fear and greed are the two biggest enemies of an investor. Don't panic sell when the market dips. Don't get greedy and chase hot stocks without research. Stick to your plan, your strategy. Make rational decisions based on facts, not feelings. This is easier said than done, I know, but mastering your emotions is key to long-term success. Stay cool, calm, and collected. And finally, the most important tip, Never stop learning. The market is a dynamic beast. It's always changing. New companies, new technologies, new economic trends. Your education is an ongoing process. It never ends. Read, research, analyze, adapt. The moment you think you know it all, the market will humble you. Stay curious. Stay hungry for knowledge. That's how you not only survive, but thrive. Now go out there and make some money. Booyah!